Simon, if I speak to a stocks guy, he's going to give me one reason for the rally in gold. It's going to be different from what the bond man is going to tell me, and a very different one from what the FX traders are going to say is going on. But the reality is that gold takes the opposite side of whatever the greatest fear is in markets. And if that's real rates, then that's the trade. What do you think?
Well, this is a triple top for gold. So the 1980 real terms level, the 2011 real terms level has now been matched a third time. The question, of course, is with real rates expected to remain negative around the world and for a prolonged period of time, then there's still an awful lot of attraction in gold. We've been strong advocates of gold and overweight in the portfolio since about 2.5 years ago when it was trading down at $1,300. I still think there's some upside here because, as we spoke about before the break, nobody here, despite their views on where the risk-free rate is going to move, can know what the public health evolution from here, the timing of vaccine, the requirement on stimulus and central bank support for fiscal stimulus is going to be. And in that environment, you want to be overweight a capital preservation device like gold. So we continue to see an upside for even at these elevated levels.
Simon, I know you've been bullish on gold for 18 months, and you're explaining it here, but what's your price? Are we going to go above $2,000 an ounce?
Well, the advantage of being an economist is I get to work with our gold mining analyst, Panmure, who has to put his neck on the block in terms of a price target. He's quite conservative because when you're looking at gold mining equities, and I think a lot of your viewers will be exposed across markets to some of the gold miners, actually want to put in a fairly conservative gold price because otherwise your models will just show buys across the piece. And actually we know at this point in the cycle, the gold mining operations that are otherwise marginal at $1,500, $1,600, $1,700 start getting approved. And that becomes a poor use of investors' funds. So we're quite conservative, in fact, below the current spot price in terms of our price target, because otherwise your asset selection criteria for investors to try and make the money in terms of buying into gold miners to get leveraged exposure is just completely out of kilter, and you just go long time at this point in the market.
I mean, it's not just gold, Simon, that's on the move. I mean, silver is actually outperforming gold as we speak. Is that something you're forecasting to move even higher as well?
Well, the gold-silver ratio is something we watch very closely. That is one of the reasons why we're very positive on Polymetal, which is the biggest London-listed gold mining company. It has big silver exposure as well, so you get both within their portfolio. Now, there are other companies out there that have that opportunity. I think I would like that mix because some investors will look to the fact that perhaps gold as a single asset is perhaps moving on a little bit of overt enthusiasm, and actually you look for other safe haven metals as a edge to that.